Good evening from New York. It's 6:23 p.m. on Thursday, March 26th, 2026. Welcome to the Lynx Data Insight Market Briefing. This analysis is AI generated by Lynx Data Insight and is for informational purposes only. It does not constitute financial advice. The U.S. stock market is closed for the day, and what a day it was. Let's get right to it.
This was the worst session of 2026. The S&P 500 closed at 6477, down 1.74%. The Nasdaq fell 2.34% to 21,416. The Dow held up slightly better, down 1.02% at 45,955. The Russell 2000 dropped 1.69%. The VIX spiked to 27.4, which puts us firmly in elevated fear territory. The 10-year Treasury yield jumped to 4.42%, and here is the critical number. Brent crude surged 5.6% to close at $108.01 per barrel. This is a geopolitically driven risk-off session, full stop. The market regime right now is supply shock dislocation, where the oil move is the primary driver and everything else is reacting to it.
So walk us through the catalyst. We had optimism yesterday around a 15-point peace plan for Iran, stocks rallied, oil pulled back. What reversed all of that in 24 hours?
Three things converged today. First, Iran's state media confirmed overnight that Tehran rejected the U.S. ceasefire offer and countered with a 5-point list that includes Iranian sovereignty over the Strait of Hormuz. That is a non-starter, and the market read it as a signal that negotiations are further apart than the White House suggested. Second, Israel announced it killed Iran's naval commander Ali Reza Tangsiri, the man who oversaw the Hormuz blockade, in an airstrike on Bandar Abbas. U.S. Central Command confirmed the strike. That is an escalation of the decapitation campaign, and while the White House may frame it as progress, markets interpreted it as reducing the probability of a near-term diplomatic resolution because you've eliminated one of the counterparties. Third, while Trump extended the pause on attacking Iranian energy facilities to April 6th, which sounds like de-escalation, the French finance minister disclosed that 30 to 40% of Gulf refining capacity is damaged or destroyed, and 17% of Qatari gas production capacity is gone, damage that will take 3 years to restore, according to Qatar's own energy minister. That is not a temporary disruption anymore. That is structural supply destruction. The G7 foreign ministers are calling this a catastrophe for the global economy, and they are not exaggerating.
That refining capacity number is striking. We're not just talking about crude in transit anymore. We're talking about permanently impaired infrastructure.
Exactly, and that is the second-order effect the market is now pricing. Let me trace the full chain. The Strait of Hormuz remains virtually closed, which took roughly 20% of global seaborne crude offline. That pushed Brent from around $60 in December to $108 today, an 80% increase in 3 months. The refinery damage in the Gulf means that even if the strait reopens tomorrow, processed fuel output is structurally lower for years. That feeds directly into global inflation expectations, which is why the 10-year yield jumped 9 basis points in a single session to 4.42%. Higher yields compress equity valuations, especially for long-duration growth stocks, which is why the Nasdaq led losses today. And here is where it gets more granular. Higher energy costs crush consumer purchasing power. Airline fuel costs spike. Fertilizer inputs rise because natural gas is a key feedstock. That flows into food prices, restaurant margins, and ultimately into core inflation readings that the Fed cannot ignore. Meanwhile, refiners like Valero, ticker VLO, are the quiet winners today, up 5.48% because their domestic refining capacity just became dramatically more valuable in a supply-constrained world.
That yield move connects to something else I want to get to. What does this mean for the Fed? The 2-year is at 3.62, the 10-year at 4.42. The yield curve is 80 basis points positive. Where does the rate path go from here?
This is the single most important repricing happening underneath the surface. Coming into this year, the consensus was that the Fed would continue its cutting cycle, with the Fed funds rate at 3.75 after 3 cuts in the past year. The market was pricing 2 more cuts by year-end. That narrative is now under serious threat. What was a gradual easing story 2 months ago is colliding with a supply-side inflation shock that the Fed cannot cut through. Oil at $108 flows into headline CPI within 60 to 90 days. If Brent stays above $100 through the summer, year-over-year headline inflation could re-accelerate above 4% by the second quarter. The Fed's playbook for supply shocks is historically to look through them, but they can only do that if inflation expectations remain anchored. The 5-year break-even has been climbing, and the longer this conflict persists, the harder it becomes for Powell to justify further cuts. My base case, the rate-cutting cycle is on pause. The Fed holds at 3.75 through at least September. If oil breaks above $120, the conversation shifts from when do they cut to do they need to hike, which would be a seismic shift in the macro backdrop. And note the political overlay. Trump called Powell a moron again today and is openly pressuring him to cut rates faster. That political interference, combined with the criminal probe against Powell that a judge has already called harassment, means the Fed chair is under extraordinary pressure to demonstrate independence, which paradoxically makes him less likely to cut.
So, who are the clear winners and losers from today?
Let me break this into cyclical and structural layers. Cyclical winners, U.S. energy producers and refiners. Valero was up 5.48%. Occidental Petroleum, ticker OXY, gained 3.22%. They benefit directly from higher crude and wider crack spreads in a world where Gulf refining capacity is impaired. Defense contractors remain cyclical winners with the Pentagon's $200 billion supplemental request for the Iran conflict. Structural winners, domestic energy infrastructure, particularly Permian Basin operators whose barrels are now viewed as safe haven production, immune to Gulf instability. AI infrastructure companies like NVDA, ticker NVDA, remain structural beneficiaries. They sold off today on the broad risk-off move, but the $650+ billion in Magnificent Seven capex commitments are not going away. And apartment REITs benefit structurally from the yield environment, keeping mortgage rates elevated, pricing potential home buyers out of the market and into rentals.
Cyclical losers. Airlines are getting squeezed by jet fuel costs. United Airlines just agreed to a $740 million signing bonus for flight attendants, and now they face higher fuel inputs simultaneously. That is a margin vice. Semiconductors took outsized losses today, with memory chip names like SanDisk, ticker SNDK, falling 7.54% and Advanced Micro Devices, ticker AMD, down 6.53%, driven by both the risk-off tone and Google's TurboQuant research suggesting AI workloads may need less memory, which is a separate headwind layered on top of the macro. Structural losers, Meta Platforms, ticker META, down 6.07%, is facing a triple threat: $135 billion in capex with no cloud revenue to offset it, 2 court defeats this week with $375 million in damages from New Mexico alone, setting precedent for a wave of social media safety litigation, and hundreds of layoffs announced Wednesday. Meta is the Magnificent Seven member most exposed to structural derating. Also structurally challenged, rate-sensitive consumer discretionary and real estate, where the 10-year at 4.42 keeps financing costs elevated and consumer spending power eroding.
I want to flag something. You named NVIDIA as a structural winner, but it fell 2.8% today. And airlines are losers from oil, yet United just got a labor deal that could be read as positive. How do those square?
Good pushback. The time horizon resolves both. NVIDIA's sell-off today is entirely macro-driven, not fundamental. The hyperscalers have committed to their capex plans regardless of oil prices. Meta alone just boosted its El Paso data center investment from $1.5 billion to $10 billion. The structural demand for AI compute is oil price agnostic, so NVIDIA is a short-term loser from risk-off positioning, but a structural winner from the capex cycle. Airlines are the reverse. United's labor deal is a positive headline, but it locks in higher cost structure precisely when fuel margins are compressing. Short term, the market may reward labor peace. Medium term, if oil stays above 100, the cost squeeze overwhelms the benefit.
What is the risk case investors should stress test here?
Base case, the extended pause on energy strikes through April 6th leads to a framework for reopening the Strait of Hormuz by late April. Brent settles back toward $90 to $95 per barrel. The 10-year yield drifts to 4.25%. The S&P 500 stabilizes in the 63 to 6,500 range through the second quarter. The Fed holds rates at 3.75 through year-end. Corporate earnings hold up because, according to Zacks, the earnings outlook is actually improving despite the energy shock. Companies have been managing through the energy shock better than feared. Risk case, Iran's counteroffer demanding Hormuz sovereignty signals a prolonged impasse. If the U.S. moves to seize Karg Island or reopen the strait by force, as reports suggest is being planned, Brent could spike to $120 to $130 per barrel. That pushes the 10-year yield above 4.75%. At that level, mortgage rates breach 7%, the housing market freezes, and consumer spending contracts sharply. The S&P 500 could see a 10 to 12% correction from current levels, putting us near 5,700 to 5,800. Growth stocks with extended valuations, names trading above 40 times earnings, would bear the heaviest losses. The Fed would face an impossible choice between fighting inflation and supporting a weakening economy, and that stagflationary setup is the scenario that breaks the playbook entirely.
So, given those scenarios, how should investors be positioned?
Highest conviction, U.S. energy producers with domestic production bases immediately increase over the next 2 to 4 weeks. Permian-focused names and refiners like Valero are direct beneficiaries of the supply-constrained environment. Secondary conviction, AI infrastructure maintain exposure structurally. The pullback in NVDA and AMD today creates entry points for investors who believe the CapEx cycle is durable, which I do, but size positions appropriately given the macro volatility. Tactical hedge, short-duration treasuries, and gold. The 2-year at 3.62 offers reasonable carry with minimal duration risk. Gold has been volatile. It was at $4,503 yesterday, but in a supply shock inflation scenario with geopolitical escalation, it remains the cleanest hedge. Core portfolio structure, overweight energy, maintain AI infrastructure at market weight, underweight rate-sensitive sectors. Avoid consumer discretionary names with high input cost sensitivity and companies carrying elevated leverage. Meta is a name I would be gradually reducing, not adding to, until the CapEx to revenue equation clarifies and the litigation overhang is quantifiable.
How does it all fit together?
When you step back, this is really about one thing, the repricing of energy as a geopolitical weapon and what that does to every asset class simultaneously. The Strait of Hormuz closure has created a supply shock that is feeding into inflation expectations, pushing yields higher, compressing equity multiples, and forcing the Fed into a holding pattern at exactly the moment the White House wants aggressive easing. The cross-asset signal is internally consistent. Oil up, yields up, equities down, energy outperforming, growth underperforming, the VIX elevated. There is no confusion about what is driving markets right now. The only variable is duration. How long does this conflict persist? The answer to that question, more than any earnings report or economic data point, will determine whether the S&P 500 finishes the year at 7,000 or 5,700.
Give us your 3 takeaways to close it out.
1. The risk. The Strait of Hormuz remains functionally closed. Iran's rejection of the ceasefire framework and insistence on sovereignty over the strait means the energy supply shock has no clear end date. That is the single largest risk to global markets right now. 2. The insight. The 10-year yield at 4.42% is not just a bond market story. It's the transmission mechanism connecting the oil shock to equity valuations, housing, consumer spending, and the Fed's rate path. Watch that number above anything else. 3. The positioning idea. Domestic energy producers and refiners offer both cyclical momentum and structural protection in this environment. In a world where Gulf infrastructure is damaged for years, U.S. refining capacity is a scarce asset. That trade has room to run.
Thank you for listening. This is Lynx Data Insight, and we'll be back tomorrow with your next market briefing.